The topic of the webinar today is what the election means for your business, batteries, solar and electrification. I'll just introduce our Sustainable Energy Solutions leadership team. So Andrew Roos is the founder and director of the business. Nick Johnson is the head of our account management team, and I play the dual role of head of marketing and key accounts. And I'm sure some of you in this call are familiar with many of the faces of our team at Sustainable Energy Solutions. In this webinar, I'll be hosting the webinar, and Andrew Lister from our partner company Beam Solar will be taking you through the section around batteries, solar and electrification. Some of you may have already gone through a Beam Solar procurement process with installations on site, so you'll be familiar with the online platform and going through their rounds of procurement and implementation. The agenda for today is going through the energy price volatility, the election implications, cheaper batteries, more electrification options, and taking action. There will be a Q&A section at the end, but we might pause during the webinar to give you time to ask some questions. Also, please feel free to send your questions in the chat, or if you want to remain anonymous, you can email them to the energy@sustainablees inbox, and our team will check those as well. Feel free to post them throughout the session, and we'll pause and go through them later on. Okay, so we'll get started. So as many of you are familiar going through the several rounds of procurement with Sustainable Energy Solutions, energy price volatility still continues. As you can see here, you've probably seen this chart through some of our webinars and summaries and discussions with your leadership and executive committees. But as you can see in the big picture for electricity, over the past 8 years or so, there's been several periods of uncertainty which have been characterised by power station closures. So it started in 2017 with Hazelwood, which was announced in 2016, and it all happened very quickly. And then things started to improve. There were some outages in Victoria in 2019. Then 2020, 2021, the energy market enjoyed a period of low energy prices where we reached 5-year lows. Then in 2022, the picture changed very quickly with the war in Ukraine, which coincided with several unplanned outages domestically. What we saw during that time is unprecedented volatility both across electricity and gas. The war in Ukraine coinciding with our own outages really highlighted our heavy reliance on gas as a dispatchable source of energy. And when the prices went up across all energy commodities globally, this resulted in the market in Australia being suspended. Since then, the market has started to recover. Then in 2023, we had the closure of Liddell Power Station, and then outages at Callide continued. Then in 2024, AEMO administered a price cap in New South Wales due to several unplanned outages. The impact, as you can see, on gas, gas prices have fluctuated over time, and I think there's many large gas users on this call who've probably experienced the extreme highs and lows that we saw in the gas market over the past 5 to 10 years. But obviously, when we hit that situation with Hazelwood, with Ukraine, as well as the Australian domestic market and our heavy reliance on gas prices went up quite high. In 2023, the government introduced a gas code of conduct, which set a price cap on the gas market for any uncontracted new gas at $12. This gas cap expires at the end of 25. It's been extended a few times, but it expires at the end of 25, which has created some stability in gas prices over the past couple of years. And what are the market drivers that are impacting energy prices at the moment? So over the past couple of years, we're still seeing rising electricity prices. So whilst we've recovered from 2022, where we saw unprecedented highs, there's still some volatility that's continuing in the market. As you can see, for example, New South Wales and Queensland are still much higher than they've been traditionally in previous contracting periods. The regulator announced an increase to the default offer for the SME market or residential market, which indicates that high energy prices are here to stay. Gas market constraints continue, and we've seen, several updates from the Australian Energy Market Operator around shortages in gas supply expected around 2028 or even earlier. Still got people joining the webinar, which is exciting. Coal plant retirement challenges, ageing coal fleet and lack of grid stability are still posing issues for energy prices. Energy generation by fuel source. So this chart gives you an idea of the split of fuels across different states. As you can see, states like Tasmania and South Australia have gone fully renewable energy. They don't have any coal generation at all. Whilst this provides them with some future security that they already have renewable energy, it also leaves them exposed to interconnectors shutting down when there's issues in other states. You can see Victoria, New South Wales and Queensland, coal is still the predominant source of energy. However, renewable energy is starting to play a larger part. Our expectation of the future is that gas generation will still play a vital role in dispatchable generation. However, our reliance on gas will decrease as batteries and virtual power plants increase as part of the makeup of the grid transition. So whilst there will still be a requirement for gas as a transitioning fuel, it will be a lower volume that's required once we've got other aspects taking part in the grid transition. So why is this relevant? I guess one of the things that you may or may not have seen is that with the amount of renewable energy coming into the grid, especially daytime, we're starting to see what's referred to as the duck curve. So where there's a lot of energy being produced during the day, the periods between 6 a.m. it starts to drop down 9, 12 and 3. You can see over the period from 9 to 3, there's a lot of solar that's coming into the grid, which is helping reduce prices during that time on a spot market. However, 6 p.m. to 9 p.m. when there's no solar coming into the grid, energy prices still remain high. This is causing challenges for both generators and retailers to try and balance the mix of generation that they need to supply into the grid, and for retailers to be able to price energy contracts when they need to forecast around solar and other renewable energy coming into the grid. As you can see, the chart on the left shows the spot prices and how they match up against that duck curve. So what we're starting to see from an energy pricing perspective is if you're a big user of electricity during that period from 9 to 3, the retailers might adjust their pricing for that period to offer a more competitive price, whereas we're starting to see some retailers offering higher off-peak prices to make up for that dip in generation, or to make up for that dip in spot prices during the day. The other thing to keep in mind is if you've got solar on your asset, this is also relevant for you, because on your site, you're benefiting from that impact where you're generating solar during those peak times of day and your own consumption is dropping during that period. I've kept the duck curve so you can see how that works, but on the left-hand side, you can see these periods below the line, where the periods of orange is where there's been negative spot prices. This is a chart for Victoria. So you can see there's negative spot prices throughout significant periods of time throughout the year. And these negative spot prices are allowing the prices to come down during the day and provide an opportunity for you to benefit from your own solar systems and be able to implement energy storage solutions to take advantage of that. The next part, I guess, of that equation is the renewable energy certificates. So some of you may be aware of the large-scale renewable energy certificates and the small-scale renewable energy certificates. These systems are in place on a federal level. So across all states, you will see these line items on your bill, and these schemes are also available for you to take advantage of on your solar and electrification projects. Now, what we've seen over time, as you can see, the VICs, so this is a state-based scheme, the VICs and the LGCs, whilst their value has been declining, there's still an opportunity to take advantage of these schemes. And essentially, time is of the essence. If you started a project last year or a couple of years ago, you probably benefited from some higher VICs in Victoria and some higher LGCs across large-scale renewable energy projects or large-scale solar systems. However, time is of the essence now. Whilst their value might be a little bit lower than they have been in the past, you still have the opportunity to partake into these schemes. There's also the STCs and the PRC, as well as the New South Wales initiatives around ESC. So for the STCs, for example, whilst the value of the STCs has remained flat, as this scheme ends in 2030, you've got less certificates that you will be able to claim. But I guess the key message here is just because the value of these are declining, you still have the opportunity to take advantage of them before some of them disappear altogether. I will now hand over to Andrew Lister, who will be able to take you further through how these impact on cheaper batteries and more electrification, and how your business can take action and go through the procurement process around these projects in the future. Over to you, Andrew.
Thank you, Caroline. All right, so I'll just take you through one big announcement from the election. And then some implications of not necessarily announcements, but what's going to stay the same or not occur. If you just go to the next slide, please. All right, so the big announcement, and this was actually before the election, was the $2.3 billion Cheaper Home Batteries program, starting 1st of July. So what this is, well, as it was announced, and all we've got to really go on is a one-page announcement. But the information we've got is that there'll be a rebate available of around $370 per kilowatt hour for batteries up to with a rebate up to 50 kilowatt hours worth of battery. So that's $18,000 of rebate. And that can be used on batteries from 5 kilowatt hours up to 100 kilowatt hours. So your typical home battery, you're looking at about 15 kilowatt hours. It's a Tesla Powerwall, and so really good for that. But up to 100 kilowatt hours, that's quite a decent sized battery for a small business or a small factory that's operating. And 18,000 is a decent chunk of money. So you can see on the chart on the right, the impact that rebate will have on different battery sizes, starting at 25 kilowatt hours and 50 kilowatt hours. It's covering, sort of 30-40% of that cost. And then as you get to the bigger batteries, you're looking at sort of 15 to 20% of that cost. So it's quite a good incentive. And we think it's going to stimulate a lot of battery installs this year. So the way it works, from what we understand, will be similar to the STC for solar. So under that scheme, the rebate is handled by the vendor, the installer. So they'll just offer you a price that is net of that subsidy. You don't need to do anything. The other rules are you need to have solar installed already, or you need to install solar with the battery. So it's got to be paired with solar. And the incentive can only be used once at the site. So, even if you're just putting in a 25 kilowatt hour battery and you wanted to do another 25 or 75 later, you can't do that. You need to do it all at once if you want to maximize that subsidy. Another rule is it needs to be VPP ready, so ready to participate in a virtual power plant. And so, there's already a list of approved batteries on the Clean Energy Council website, and we think, there'll be a separate list or, an additional list that will cover batteries that are eligible for this scheme. So it should be nice and simple. And then although it starts on the 1st of July, you can actually install a battery now and as long as you don't switch it on until the 1st of July, that would be eligible. So they just want to avoid kind of stopping all battery installs from now until that scheme comes into effect. And then who is eligible? So in the media release, they say households, small businesses, and community facilities will be eligible. That's probably the big question, which I'll cover in the next slide. So, will your business be eligible for the rebate? That's what we don't know yet. So, on one hand, they say, small businesses, community facilities. So it might work similar to the New South Wales PDRS battery scheme, where you need to have 100 employees or less to be eligible. On the other hand, they're saying it's going to work really similar to the STC. If that's the case, there's no eligibility test around whether you're a small business or not. So we need to wait and see on that. I suspect it's probably going to be closer to the latter, that everyone will be eligible, but we just don't know at this stage. Can you receive other subsidies? It looks like you will be able to. So the PDRS, you'll be able to kind of double dip on that. If you're in New South Wales, that's another $2,000 for, batteries up to 26 kilowatt hours. And we sort of covered this before, do you have to have solar already? No, you don't. You can, put solar in with your battery, and you're also eligible if you've got solar already. Comes into effect 1st of July, as we mentioned. And, how do you claim this rebate? So again, we think it's going to work really similar to the solar STC, where you really don't need to do anything. The prices you're going to get from battery vendors and installers is going to be net of that discount, and they'll sort that all out on the back end. And yeah, what do you do if you're not eligible? So that 100 kilowatt hour size, that's quite good for small businesses. It's probably too small to make any reasonable impact if you're a large business. So in the next slide, I'll sort of cover what you might do instead. First thing to sort of understand is what are the how do batteries kind of make a return, and what's the point of putting a battery in? So there's sort of 5 ways that batteries can earn money. The first way is load following. So typically that's if you've got solar and you've got excess solar during the day, you might be exporting that, but you're not getting any revenue for that. With a load following battery, that battery will suck up that additional power during the day to charge up, and then it'll discharge in the evening or during higher price periods to get a return. Second operating method is called peak lopping or peak shaving, and so under this operating methodology, the battery will charge when your demand is low and then discharge when your demand is high, and it'll be able to bring your maximum monthly or annual demand down, which will save on your demand charges. Related to this, the third method is demand response, and this is where particularly in Western Australia with the reserve capacity mechanism, parts of Victoria with kind of peak capacity intervals, and then there's also some incentive schemes in New South Wales where during certain days of the year or certain times of the day, there'll be a really big financial incentive to reduce your demand as much as possible. Doesn't have to be zero, but it can be, and it can be exported as well. And so your battery will essentially sit there and wait for these price signals and or these periods of the year to discharge and supply your site, bring your demand down. You'll get a lot of revenue for that. And then particularly for large sites, the next one is what we call virtual power plant, and that's where you essentially hand over control of your battery to a third party. These are typically called aggregators. They'll aggregate up hundreds or thousands of these batteries across the country, and they'll operate them as a virtual power plant. So they'll essentially be trading energy based on charging and discharging that battery. to take advantage of, really low spot prices to charge up, really high spot prices to discharge. And then they can also charge and discharge under the FCAS, Frequency Control Ancillary Services market, which provides grid stability. The last way to use your battery is backup power. So if you're a site that, losing power costs you a lot of money, you might be a factory and having, 30 minutes downtime throughout the year is bad. You'd lose inventory or lose time, production time. The battery will basically sit there and provide backup if the grid goes down. So they're sort of the 5 ways that these batteries can operate and make money. And if we go to the next slide, we'll give you a sense of kind of what money we're talking about. So on the right is a chart of the revenue for each of these operating methodologies. This is for a 1 megawatt or 2 megawatt hour battery. So this would be a $1.5 million investment, and you can see that for load following, the returns are pretty low. So you wouldn't install a battery if that was the only revenue you're going to be making. You start to make a bit more with a peak lopping battery, depending on your demand charges. So that can be worthwhile if you're in if you've got really high kVA charges. But you can see the real money is really in virtual power plant with the spot and FCAS revenue, or critical capacity mechanisms like in WA and Victoria. You can start to earn real money under those schemes. And you see that last one, we're doubling up on both virtual power plant and capacity, which can be done depending on your site and how you sort of set that battery up. All right, if we go to the next slide. So this is just, if you're a small site, you're capitalizing on this, the cheaper battery scheme with a battery, 100 kilowatt hours or less. You could probably, cross off the demand response. That battery's really just not going to be big enough to play in that scheme, and the sort of volumes of, the sums of money we're talking about, aren't really big enough at that scale. So you might look at the load following, peak lopping. You could look at virtual power plant. You'll get a smaller revenue share because of the size of that battery, but can still, provide some revenue. And if your total load's less than 50 kilowatts, you might consider backup power as well. So you can see on the chart on the right, before the battery program, the cheaper battery subsidy, you might be looking at a 6.5, 7 year payback. With that subsidy, you're now looking at a 5.5, 6 year payback. So it's shaved a year off the battery payback, which could be good for a lot of sites. On the next slide, if we look at the larger batteries, so as I mentioned, you can sort of cross off load following for these large sites. It's just not worthwhile. But depending on where you're located, demand response or virtual power plant or backup power is really going to be where you earn money. So on the right, I've got the potential revenue you get under spot and FCAS markets in each state in Australia if you're operating as a virtual power plant. So you can see, Queensland, this is for last year, this is 2024. You can see Queensland was very lucrative, as well as New South Wales and South Australia. So in these regions, looking back at Caroline's slides on the, average spot prices, New South Wales, Queensland and SA, this is where we had the, really low prices during the day and really high prices at night. And so that's how your battery's earning money. And then also in Queensland, the FCAS market is really strong. And that's why, you've got a lot of FCAS revenue in that state. I'll just do one more slide and then I can see some questions coming up. So I'll pick those up after the next slide. All right, so just some other kind of key points to consider when you're looking at a battery. They essentially need to be installed outside or on a dedicated premises. So if you have a look at the images on the right. The top one's around 100 kilowatt hours of battery. So that's, you can get an indication of the space required for that. That's in a dedicated facility. And then below that, you've got about 1 megawatt hour of battery that's situated outside. So, key point, you do need to find some space to put these things. They, like solar, they need to connect to the grid. So you need to do a application and need approval from the DNSP. And, you're sort of competing with solar to some degree for how much embedded generation you can connect at a site. So, sort of getting the, right sizing both of those things is quite critical. The other thing is, the technology's moved on a long way in the last 5 years, and so they don't degrade as fast. You're going to get, more than 10 years out of your battery. You look at some of the vehicle batteries, which are the same technology, they're doing millions of kilometers without too much degradation. And in other good news, those costs have declined quite a lot in the last year, and will continue to decline. So there are a lot, if you looked at this 2 years ago and it didn't stack up, it might very well stack up quite well now. I'll take a pause here. Are there any questions? I see one here from Peter. With a VPP, can that be detrimental to your own use, i.e. restricted use of power, or is your usual usage levels kind of guaranteed? So with depending on if you're a large or small site, if you're a large site with the VPP, you're typically, you'd put the battery on what's called a child meter. So that battery will still be constrained by the physical flow of electricity into and out of your site, but it's not going to override your site usage. It's going to be kind of capped at whatever your demand needs to be at the site. It'll only charge with what's left over. But financially, that'll be on a separate meter. So you'll actually be the price you pay for using electricity under that child NIMI will be based on the spot market, and same with the discharging that battery. And then for the smaller ones, same sort of applies, but you're not on a child NMI, so it'll always be prioritizing your site usage first. With the other thing to note, with the FCAS market, there aren't large volumes of electricity moving. It's quite short periods of time. One more question from Margaret. What is the risk of fire? Really, really low now. So most of the batteries use lithium iron phosphate technology, which does not have the same fire risk as the NMC, nickel manganese cobalt batteries. So that fire risk is a lot less. However, you'll see with the building codes, this is why batteries are still specified to be outside, to just mitigate any remaining risk on that. All right. If there are no more questions, I'll move on to the next section. All right. So this next group of points which are around renewables and electrification, these aren't so much new announcements, but it's a continuation of what we had, and also what's not happening under a coalition government. So the what's the same or increasing? So renewable energy target is staying. That's legislated out to 2030. So that's the STC and the LGC. The money available under those declines over time to 2030, but they are remaining. And then we've got the guarantee of origin scheme, which is going to replace the LGCs after 2030. That's still coming into force. ARENA, the Australian Renewable Energy Agency, is remaining. That that's quite a large fund for supporting commercialisation of electrification technologies. I know there's a couple of sustainable energy solutions customers that have funding from that or are going for funding under that. So that's going to remain and probably be increased over time. The Clean Energy Finance Corporation that provides finance for renewable projects, that's going to remain. And then Rewiring Australia, which is a pretty large investment in transmission infrastructure for renewables, that's staying in place as well. So all of those things, they're going to lead to more renewables on the grid, which is going to lead to more higher highs of pricing and lower lows. And then the things that aren't happening, when the coalition proposed a gas reservation policy, that would likely have brought down gas prices. So I think we're going to continue to see high gas prices. And we're not getting nuclear, that would have delayed the closure of a lot of the unreliable coal-fired generation. So we're going to have probably a little bit more stability in price without the nuclear. If we go to the next slide, the implications of that, if you're considering an electrification project, there's the incentives under the renewable energy target are going to remain. That's really good. You've got potential funding sources in ARENA and CEFC. And then with all that renewables on the grid, the high prices is going to be great for batteries. The low prices are going to be great for batteries and thermal energy storage. And, the electricity is going to be less carbon intensive. So switching from natural gas to electricity is going to have a big impact on your emissions reduction targets. And then with the no gas reservation policy, we're going to have higher gas persisting. And so it makes that switch to cheaper electricity much more attractive. So what do you do if you're a small business, or a small site, commercial or retail site? Things you can be looking at are replacing hot water with heat pumps, especially if you're in New South Wales or Victoria. There's really good incentives in place for that. Same for your gas heating. If you've got that, heat pumps are really efficient, really reliable, and they're going to reduce your emissions significantly. And it's probably a good time to start looking at replacing, petrol or diesel vehicles with EVs. Your cost of fuel is a lot lower, particularly if you can charge during those, really low priced periods. If you're a large site, so large manufacturer or commercial site, same thing applies with the hot water. And you can get incentives, the same SKNV incentive in New South Wales and Victoria. So really good time to consider those projects. If you've got a gas boiler, really good time to consider thermal energy storage. So that's that picture on the bottom left, or electric boiler. That's the picture on the bottom right. So the way thermal energy storage works is it will charge during periods of low or negative price electricity. So, you saw that chart of the negative spot prices. So most of the year it'll get paid to charge up with electricity, and then you discharge when you need that heat. So you've got heat up to 700 degrees. You can use that heat, in your process, or convert that to steam in your process. So, it's a straight boiler replacement. And then you can also look at EVs for your fleet, or heavy vehicles. All right, so plenty of options there to consider. And so what do you do to take action? So first point is probably no need to rush into this. These are big projects, they're big capital investments. So you should really kind of think about all of this in your decarbonisation plan or your capital investment strategy. And the first step is really to understand what your options are, what are the associated costs and benefits, which our platform can help you with. So if you go to the next slide, the first, and I know a lot of you on the call have used our software for this, but the first step is what we call assessment. So we work with Sustainable Energy Solutions to look at your usage data. We ingest that, what your tariffs are, what your future energy prices are, and we essentially model up a whole lot of different size solar, battery, power factor correction systems at your site, so you can see what the potential costs are, what the potential benefits are. From that, you can choose, what makes sense to invest in. Once you've made that decision, you move on to the next step in our process, which is procurement. If you go to the next slide. And so we take that project and we put that out to vendors on our platform. You can see the logos there. We've got about 50 vendors that can install projects throughout Australia. Solar projects, battery projects, EV charging, power factor correction, generators. And so all of those revenue streams we talked about, they can provide offers into that for the batteries. And so what we've done, we have a vendor rating and qualification system. So we've got really up-to-date and accurate ratings on how good these vendors are at implementing projects, and they do change over time. So I've had some vendors that were really good and their quality's dropped off over the last year or so, and we've got other vendors that we're sort of average quality and have improved over time. So rather than just going back to the vendor that did a project for you before, it's definitely worth considering other vendors. The other thing we find is any given time we have vendors that are keen to do projects at low cost, because they've just finished a project nearby, or they've got capacity or stock available. So really good to test the market on that. And then, thirdly, the third way we help you is on the managed side. So once you've contracted for a project, if you just go to the next slide, Caroline, we will assist with the project management, so making sure that project gets delivered on time and on budget. As an owner's engineer, we do a quality audit of that project. So you get a report like that one in the middle that'll tell you everything that was done right, everything that wasn't done right, and that informs your defect liability register to have the solar or battery or EV charging installer correct any defects, and then we provide ongoing monitoring of that system to make sure it's performing and validating the savings you've got from it. So if you're considering a project, first place to start is really assessment. And if you get in touch with Sustainable Energy Solutions, we'll work together on helping you assess those projects.
Thank you, Andrew. There was another question that popped up on the chat, so I might read that out. And if this is the end of the formal part of the webinar, if anyone else has any questions, please either type them through or pop your hand up to ask the question on the video. So I'll read out the question that we've got on the chat. Are there any indication of battery incentives for large market sites? And with small market, when will eligibility be defined? For example, number of employees, etc.
Yeah, great question. So on the large side, probably not. There's probably not going to be any incentives. ARENA did fund a bunch of community batteries last year, and then they kind of renewed some of that funding early this year. We think that the technology is probably mature enough that they won't do funding for that at sites, but you never know. They may do that in the near future. But short answer is we don't see any. On the small sites eligibility to the cheaper home battery scheme, again, we don't know. We would hope we get something before 1st of July when that scheme officially starts. I was expecting something by now anyway, but we haven't seen that. So I think watch the space. as soon as there is an update, we'll work with Sustainable Energy Solutions to get something out to customers such as yourselves on what that looks like.
Andrew. Nick Johnson.
Thanks, Andrew. Just had a quick question, actually. So you ran through some different ways that people can take advantage of installing the batteries, and that was, load following, lopping, the VPP and demand response and everything.
Yeah.
Are the batteries set up? Are there smarts behind the batteries to do it for you, or what's involved in setting those sort of things up?
Yeah, 100%. So on the first, so all batteries have have inbuilt control, and most of them, I'd say, if not all of them nowadays, have connection to the internet, which allows external control. So that on the load following and peak lopping, they're really just set and forget. They'll monitor your site load and control themselves accordingly. On the demand response and virtual power plant, you're really handing over control to some degree to a third party to control that battery. They've got really sophisticated software that will look at the markets on a 1 second basis and control the fleet of batteries, including your battery, to charge or discharge based on that price signal. And then they'll handle all the billing and everything at the back end, and essentially just pay your revenue stream, on a monthly or quarterly basis. So the batteries are really smart now, and you're not going to be sitting there at your site having to figure out how to control it. That'll be done for you. The one exception to that would be the backup power. That's where if you've got a generator on site, you need to configure that appropriately, and then but again, that's sort of set and forget. So if power goes down, that battery will automatically switch over and integrate the generator where it needs to.
Great, thanks, Andrew.
Drew, I've got a question regarding the timeframe for applying, installing and liaising with the network and relevant bodies. So obviously we know we can't, if we're eligible for a rebate or to claim the STCs, we can't turn the battery on until the 1st of July. But what's the process of, once we get past procurement, what's the process of applications, installations and timeframes around that?
Yeah, great question. So the vendor will sort all of that out. So once you're contracting, one of the first things they'll do is finalize the design of your system, and then submit an application for connection with the network or the DNSP. And for small sites, there are defined timelines for that, typically 30 days in most regions, that the network needs to come back and say, yes, this is approved, or yes, this is approved, but you need to, install something else or configure it slightly differently. Most of the time it's yes. So that would cover all those sort of 100 kilowatt hour batteries, sort of 30-day timeline for that. For your bigger ones, it's a lot more variable and dependent on the region you're in. New South Wales and Victoria, fairly quick turnaround time on approval if you're an Ausgrid or Endeavour or some of the Victorian networks like Powercore. However, if you're in WA or Queensland, there can be really big delays in getting that approval. Similar for solar, you could be looking at up to a year from signing that contract until you get approval from the network to install that system. So that's another thing to be conscious of. In terms of timing, it makes sense to start these projects now because they can take a long time to get implemented.
If you're claiming the STCs or LGCs, are they calculated at the time the system is commissioned, or are they calculated at the time the quote is provided and the system is costed up?
Yeah, so STCs, it's time of install, and so you always see a big rush in December for solar projects, and I think we'll see the same for battery projects, because there's a big difference in the rebate on 31 December versus 1st of January. The LGC is generation based, and so is the VEEC, where it's basically the output of that system, or the reduction in load at your site over time that you're basing that claim on.
Great. Any other questions from the webinar participants? Either type in the chat, or please turn your video on, or raise your hand. If there's no other questions, then we might wrap it up, and we will send through a recording of this video and also a summary of the Q&A that was asked prior to the session and during the session. Thank you all for your time today.
Thank you.